Good afternoon, everybody. Thank you for joining us today for Financials 101. Um, you might notice you've been joined in listen-only mode, so you're not able to, you know, to speak. That's just because of the number of attendees we're anticipating today. We want to kind of minimize interruptions and background noise. That does not mean we don't want your participation and your input. So please feel free to introduce yourselves, say hello in the chat. If you would like to share, a little bit about what your business is, you never know who might be listening or might be in the Zoom room with us. So please feel free to introduce yourself and your business in the chat as we go on. My name is Isabel Crome. I'm the Associate Director here at the SBDC at Temple, and I'll be leading today's webinar. As we go on, if you have questions, I invite you to put them in either the Q&A function. If the chat is busy, we'll be a little bit more quick to see them if you drop them in the Q&A feature. If I'm speaking too quickly, if you have questions about a word I'm using or anything else, please don't hesitate to speak up. You never know who else you might be helping when you share those kinds of questions. So without further ado, I'll go ahead and start us off today. All right, so let's start by introducing the Temple SBDC if this is your first time coming to one of our webinars. So the SBDC at Temple is hosted by the Fox School of Business here at Temple University, and we've been serving the small businesses of Philadelphia and Montgomery counties since 1983. And those statistics you see along the bottom are for the national SBDC network. We're very proud to be part of a national network of small business development centers funded by the Small Business Administration. We ourselves also receive funding from this Pennsylvania Department of Community and Economic Development. The SBDC national network helps create a new business every 26 minutes, a new job every 5.7 minutes. So we're, proud to be continuing in that tradition here at the SBDC at Temple. Our services are wide-ranging. We are kind of specialized in no-cost business consulting. That's kind of what we're known for. And that was my role here at the SBDC until quite recently. So if you're interested, if you have an SBDC consultant, reach out to them over email. If you don't yet have one, we'll include a link to request consulting support in our follow-up email. And there'll be a QR code at the end of the presentation that you can scan as well. No cost consulting begins with determining what your objectives and your goals are for your business and assessing your kind of prioritizing your needs. And then you're assigned to one of our, qualified business consultants. We take meetings at 3 different campuses around Philadelphia as well as virtually. And we can work on all kinds of issues related to your business, a business plan, seeking support with a loan application. The subject of today is all about financials and financial management. We can also help you with, reviewing your current kind of business financials and doing a little bit of an analysis of what's going on in your business financially. We also have, a marketing consultant who can support you with marketing strategy, all kinds of good stuff. So just a little bit about us there. And we also have a variety of webinars like this one and other kinds of training programs. Be sure to check our events calendar. We add new events pretty regularly. We have a virtual business planning class. It's actually kicking off today. It's going to be a 6-week-long business planning class. We have a wonderful construction management course that's a longer term. I think it's a 9-month course for construction businesses looking for some industry-specific support. And we also have a ton of our webinar recordings on our YouTube channel. We don't post the recording for every event, but we do post them for a certain number of them. So if there's a topic you want to learn about, and you don't see anything on our events calendar, check us out on YouTube. And here's a little bit about me, in case you're wondering who I am and why am I talking to you. There's a picture of my face and a little bit about me. I've been working with small businesses for over a decade. I've been a small business owner. And I'm currently the associate director here at the SBDC. Before this, I was one of our business consultants. So here's what we're going to be talking about today. We are going to be going through kind of the basics of budgeting. We're going to be talking about record keeping, do a little bit of an introduction to financial statements and how to read and utilize the information in your business's financial statements. We'll also talk about building strong habits for managing your company's financials, and what that might look like at different stages of your business. Question, is it too late to join? It might not be. Reach out to us at I'm going to actually encourage you to reach out to the instructor for that program, and I'm going to send you her email in a private message. So please do feel free to reach out to us about that. I think there are still 1 or 2 slots left in that business planning class. All right, sorry for that interruption. So today, like I said, we're going to be talking about what kind of strong financial management habits look like for an entrepreneur at different stages of your business. Before we go on, I'd love to get a sense of who is in the room. Do me a favor and use that raise hand function. Raise your hand if you are running an existing business, if you are already in business for yourself, running an existing business. Any stage of development, any size of business. Okay, more and more of you. Wonderful. Okay, that's very helpful. Okay, and I'm gonna, any of you all who wish to join that class, normally I'd say reach out to us at our main office number, but I know that our office admin is away from her desk today. So go ahead and reach out to our director, Erica. The email address is in the chat. Okay, thank you all for raising your hands. That was very helpful. How about those of you, raise your hands if you are planning a business that has not yet started. If you're in the startup stage, but you haven't quite launched, raise your hand for that. No wrong answers here. It'll help me in kind of where I focus and how I address certain topics. Okay, nice healthy bunch of planning stage businesses too. Wonderful. Thank you so much. Okay, so our agenda is unchanged. We're going to talk about budgeting, record keeping, doing a little bit of a financial statement analysis introduction, and then talk about managing your business's financials and when and how to do this in a practical way in your business. So let's start with budgeting. So budgeting, there's different kinds of budgeting for a business, of course. And so, a pre-venture business, it's very critical that you develop that startup budget, right? How much capital do you need to launch your business, get things off the ground? And how much, and then business expansion budgeting, if you're considering expanding your business in some way, adding a new offering, expanding into a new market, hiring an additional, additional staff, you might budget for that and think about what the costs and increased revenue might be for that expansion, and kind of evaluate the profit feasibility of that expansion, as kind of similarly to the way a new venture might plan its financials before it launches. And of course, there's also cash flow management. Maybe your business is in a good place. You're happy with the size of your business, but you want to make sure that you're keeping an eye on things. So we also use budgeting for cash flow management, and we'll talk towards the end about how to incorporate that practice into the day-to-day and week-to-week operations of your business. We're going to start by talking about startup budgeting. That's a big source of our kind of consulting work. A lot of folks come in with business ideas, and they need a little bit of support developing the startup budget, and then thinking about the funding sources that will help them, access that capital to launch the business. So the goals for a startup budgeting process are to verify the financial feasibility of the business model. And this is very similar for expansion budgeting. We want to make sure that the whatever the expansion is going to pay its own bills, carry its own weight, right? You also want to make sure that you have enough funds available to establish the business. You want to make sure the business isn't going to run out of cash in its first weeks or months. And so you want to set goals for raising the necessary financing before you actually start fundraising, so you know how much you need, whether you're getting that from personal savings, friends and family, small business lending, professional investors. You got to know how much you need before you start raising those funds. So in order to create a startup budget, you need estimates of all of your expenses, and all those startup expenses and all of those your operating expenses. So operating expenses are the bills that you'll have once you're up and running. You might hear this referred to as your overhead. But operating expenses typically also include your direct costs like payroll, inventory, and other things that are not typically included in overhead. And so we always start by thinking about the different categories of your budget. So here are those different categories, and I'll go ahead and let you read this slide. It's long. I'm not going to read it all to you, and you'll get the slide deck after in the follow-up email from the course. But the important thing to be aware of is that budgeting is always about, it always begins with best estimates, right? Even the most established business, when they think about what they're going to be spending and making in the next month or year, you're estimating based on what has happened in the business previously. For a startup, you're estimating based on, your own industry experience, what you've found from other businesses that you might be familiar with, what your research has told you, but it's always best guesses. So it's very important that you be tracking those expenses as you begin to operate and analyzing whether or not you were correct. You don't necessarily need to have all the facts before you begin your budget, but you need a best guess and a way to evaluate whether you were right. For each of these categories, there are important decisions that you'll make as an entrepreneur, such as, for revenue, product-based revenue. Should you expand your product inventory? Should you expand the variety of products that you offer? How much of your business assets should you keep in inventory versus in cash? Those are pretty critical decisions for product-based businesses. Carrying too much in inventory can weigh you down. It can, decrease the working capital you have available to you. Carrying too little in inventory in a time of, supply chain uncertainty can be unwise as well. So striking that balance is really critical. For service-based businesses, you might be thinking about the price point for your services, or different ways to different marketing strategies you might need to incorporate to increase your sales, maybe new distributions channels. Direct expenses. So direct expenses are those expenses that are related to the product or service that you offer very directly, that increase with the number of sales that you have. So, if you're a coffee shop, your direct expenses would be, coffee beans, paper cups, things like that. So you might be thinking about, are there opportunities to lower your production costs? Do you have the right supplier for your inventory? Those are the kinds of decisions that you might make about direct expenses. And it goes on down the line. And again, I'll let you read the slide. So as you're developing your budget and going through this practice of budgeting, tracking your income and expenses, and then analyzing at the end of a given period, was I right? Was I wrong? Was my estimates high or low? These are the kind of decisions that you make based on that information. So here's an example of a budget for a startup business. And these are all the expenses that this business is going to have before they launch. So they're thinking about the operations requirements. So this is a sample budget for a roadside services business. So they're targeting transportation companies, trucking companies, and similar things who might need roadside assistance. And so it's a B2B model. Their operations will require mechanics who will need to be paid, service vans that will need to be bought and maintained, parts inventories that will need to be stored somewhere and also purchased, as well as management and administration, back office support, your dispatcher, right, your office administrator. In terms of facilities requirements, they'll need office space and professional services, parking space for vans, warehouse storage for parts, and then other requirements, marketing, direct sales efforts with transportation firms, and insurance. And so you'd want to have numbers attached to all of these different details. And when you're thinking about these numbers, you're thinking in terms of three basic kind of buckets: the cash you need to start the business, the cash you need to run the business, and what cash is coming into the business. So for that startup budget, the cash needed to start the business, your incorporation fee, initial inventory, your lease signing, your setup costs. So, for that office space, maybe furniture, desks, computers, equipment, those vehicles, any kind of equipment that's needed to provide the services to the roadside services. Maybe there's renovation that's needed in the facilities you're renting, things like that. You'll likely have professional fees, an attorney, accountant, consultant, whoever it is that you might need to pay. Not every business will have these, but many will. And certainly there's costs that can be associated with launching a website and launching those marketing operations as well. Cash needed to run the business, Direct costs are a big one, right? So those direct costs will be different for different kinds of businesses. In this case, those might be, the costs associated with paying mechanics, gas, insurance on the vehicles, maintenance on those vehicles. Um, um, Indirect costs like overhead would include rent for the various facilities the business uses, utilities for those office space, um, equipment maintenance, insurance costs, professional fees. So all of these are the costs that certainly need to be covered by the sales of the business, and not just by the gross sales, but by the profit. And we'll talk when we get into financial statements about the difference between those numbers. So what is the cash that's coming into the business? It's going to cover those expenses. We've got revenue from operations, that's sales. Maybe there's also other forms of revenue coming into the business, subscriptions. Maybe they're subleasing some of their space to another business. Maybe they've got IP that they're licensing out. So you want to be considering all the different ways you could be monetizing your operation. Do your spaces sit empty during a time when someone external might want to rent it out? Could you collaborate with another business to create a new revenue stream that benefits both of you? Are you an expert in a skill that people will pay to learn, etc.? Right? So maybe maybe there are opportunities that you haven't considered. Not necessarily part of our budgeting conversation, but just always something I'm thinking about. Have you left any opportunities, any money on the table? And then maybe there's other incoming cash as well. Proceeds from a loan, investor funding, etc. Those would also need to be factored into your budget, because they typically have a cost associated with them, repaying a loan, or dividends to an investor, et cetera, et cetera. So how do we actually develop the budget? So there are tools for budgeting and record keeping, and I'm talking now about tools both for budgeting and for record keeping, and we're going to pivot quite soon to talk just about record keeping. I think you can get a lot done with a good spreadsheet. Excel, of course, is a great spreadsheet software through Microsoft Office, but Google Sheets, which is a little bit easier to access. It's free for, Google, folks with Google accounts. Also a very powerful tool, very similar to Excel. A lot of the same formulas you're used to in Excel will work in Google Sheets and things like that. So a good spreadsheet will get you pretty far. There's also online drag and drop budgeting tools. So there's some AI powered budgeting tools you can use. LivePlan is a great example of one of those. There is a subscription cost associated with it. And they've gotten pretty smart about their revenue models. So it's not that easy to get the budget you develop out of LivePlan without paying for the privilege. But it's a very easy to use platform if you're interested in exploring that. And then, of course, for record keeping, there's all kinds of bookkeeping software out there. Some people continue to use spreadsheets to manage your records and maintain your business records. As your business kind of grows and your cash flow increases, this is the kind of thing where you might want to subscribe to a bookkeeping platform and simplify your life a little bit. And there's a couple here. QuickBooks is kind of the brand name. It's not the only game in town, but it's certainly the most well-known of these bookkeeping software platforms, and they have all kinds of different tiers. Some less expensive, some more expensive. FreshBooks and Wave are other competitors, and there are some. There's bookkeeping software is expanded to include all kinds of kind of operations management software. So you might have, a bookkeeping platform that also manages your inventory, or a bookkeeping platform that also is your payroll provider and manages your payroll. So keep in mind what you need when you're looking around for budgeting software. Sometimes people ask me, when should I spend money on record keeping? When should I pay for a platform like this or hire a bookkeeper? And what I see over and over again is that when you're just starting out, you have more time than money, right? And many bookkeeping is one of those things, like many other problems, that you can solve with either time or money. As you operate, you may begin to have more money than time. Time is a pretty precious commodity for a busy entrepreneur, as the half of you who are in business can attest. So in the beginning, you may be able to maintain your own records manually using a spreadsheet. I don't recommend a shoebox full of receipts. That's a terrible method of record keeping, but you may be able to maintain your own records, especially if you're using software that automatically syncs to your accounts, like some of these QuickBooks QuickBook platforms. So as you begin to have more money than time, consider what you can automate, delegate, and outsource, right? So the great thing, the reason I think people, one of the value propositions for bookkeeping software is the ability to automate many of these record keeping tasks, right? QuickBooks and other record keeping platforms often sync with your bank, with your online bank account, with your credit card, with your merchant services, or your payment processing system. So they automatically input transactions, expenses, sales, and then um, they often are automatically categorizing those transactions, which is that is a big time saver, as opposed to having to manually enter every sale and every purchase into a spreadsheet. Um, and then beyond that, if you begin to run out of time to even do those kind of categorization and managing the bookkeeping platform itself, maybe you eventually delegate those bookkeeping tasks to an external bookkeeper, or depending on the scale of business, to an internal bookkeeper or controller. The last financial task that any business owner would delegate, and many business owners never do, is financial monitoring. Keeping track of the business's cash flow and monitoring financial performance. And we'll talk towards the end about how that's important, why that's important, and how to make that a habit as a business owner. Um, why does record keeping matter? I do occasionally get this question from people. Why do I have to keep business records? And I'm here to answer it pretty quickly. I hope this isn't a question any of you are wondering about, but if it is, why does it matter? Well, first of all, it's a legal requirement. You have to. The IRS dictates that businesses must maintain 7 years of financial records. That includes history of transactions and expenses, and that each transaction, whether it's a sale or an expense, should include the dollar amount, the date, the customer or the vendor who was paid or who paid you, and notes associated with what with the nature of the transaction. So that's a legal requirement. It's also super important to capture deductible business expenses to minimize your tax burden. But I think more importantly than any of those things, those are obviously, I think, enough, hopefully, to convince some of you. It's also extremely powerful to have access to the financial data for your business, so you can monitor performance and profitability and make those strategic business decisions that only you as the business owner can make, based on hard data, not on vibes, right? Also, if you're going to be seeking financing at any point, going for a small business loan, seeking an investment, you're going to be asked to provide financial records and financial statements. And it's essential for financing. So if you ever want to sell your business, you got to keep good records. If you ever want to get a business loan, you got to keep good records. If you want to make better business decisions, keep good records. It begins with keeping good records. None of the rest of what we're going to talk about today with financial statement analysis and financial decision making is possible without having good data to begin with. Garbage in, garbage out, right? It begins with having good bookkeeping habits and accurate business records. All right. I'm getting off my soapbox here. It's just something I feel strongly about. Now, once you've got good records, once you've made a practice of getting into good habits, keeping good business records that have the right level of detail, that are categorized appropriately, so you can sort the data out. Okay, what were my sales from this location versus this location, this product versus this product, this kind of customer, this kind of engagement versus this customer, this kind of engagement. Those categories are really, really helpful. Once you have those records all set up, what do you do with them? Well, let's talk about reading your own records. And that brings us to financial statements. So how many of you, show of hands, know what I mean when I say financial statements, or could name kind of the 3 basic financial statements? I won't ask you to, but just show of hands. Okay. Some. Wonderful, wonderful. I'm glad you're all here. So financial statements are a summary of the company's financial performance over a period of time. It could be a month, a day, a year. They reflect the business's activities, and they're based on business financial records. And that's what we were just talking about, keeping track of those records. Financial statements provide a snapshot of a business's financial health. And if you know how to read them, they tell a story about what's going on in the business, what's going well, where are the challenges, is the business in good health, is it struggling? You can tell an awful lot about a business from its financial statements. So let's learn how to decode them. There are three main financial statements. They are the balance sheet, the income statement, which is often called the profit and loss, and the cash flow statement. So what are these? The balance sheet is what your business owns, its assets, versus what you owe, your liabilities. And we'll look at a balance sheet on the next slide, and I'll kind of take you through how it works. The second type is the income statement. This is where you see what the business earned and what it spent over a given period. And you see how those are different, right? I can own a piece of machinery, and that doesn't mean I've made any money using it, right? So your balance sheet is a snapshot of the business at a moment in time. These other two statements are typically over a specific duration. A balance sheet is a snapshot at one point in time. So if somebody asks you for last year's financials, you would say, okay, so I'm going to give them 2024 income statement. So January through December 2024 profit and loss, cash flow statement for that same period. Often this is a monthly breakdown. And then I'll give them a balance sheet for what my company owned and owed at, midnight on December 31st, 2024. And that's that snapshot of your business at a given moment in time. The cash flow statement shows how the business is using its cash. What cash does the business have on hand? What is it spending that cash on? So this is different than the profit and loss in a pretty important way, in that if your company took out a loan, right, that loan would not show up on your income statement, except maybe as a capital expense, debt repayment, but it wouldn't show up as income, right? But it is money that came into the business that you're able to use to grow the business. It changes, you're spending that money on things. The cash flow statement shows where that money is coming from, where it's going. All right. I'm going to take us through some of these financial statements. And as we go through these are financial statements that I have generated. They're not for a real company, but I'd like to show you a little bit of how to read them by giving you a close to real life example of these financial statements. So these financial statements I'm going to show you are for one retail operation that has two different locations. And so the statements are, have location A and location B. The trick with financial statements is you can read them in multiple ways. You can read them top to bottom. How much did you make? How much did you spend? How much was left over? That's your profit. You can also read them horizontally, side to side. So you can say, how much did I make compared to last month or the month before or this month last year? And that's a horizontal analysis. What was my profit percentage this month compared to last month compared to this month last year? And financial statements are not as useful if you see one set of numbers at this point in time with no additional context. So comparing one location to another gives you that context. Comparing this year to last year gives you that context. Comparing this year to last year to the year before that, now you can start to see some trends. This month to last month to the month before that, again, you start to see some trends, and there's power in those comparisons. You begin to get, you can, the insights that you get out of your financials are more useful, more relevant, the more context you give yourself. Even better is if you can find a percentage breakdown of what a typical, financial statement looks like for a business in your industry. Then you can see even better. Am I, above or below that benchmark that I found for, say a restaurant business's profitability or what have you. So let's go through these. We're going to start off with the balance sheet. As I'm going through these, I'm going to show you, again, location A, location B. So you see here on the balance sheet, we've got assets. That is cash on hand, accounts receivable. What people owe you is considered an asset, right? If you've got outstanding invoices, people still owe you, that's accounts receivable. And then you have inventory. It's not cash, but it's still worth something. It's an asset. And many businesses may also have fixed assets, things like equipment, real estate, that are kind of that are owned by the business and could be liquidated or sold if needed. So those would also show up here. This business happens to not have any fixed assets, frankly, because I didn't want to make this more complicated than I needed to. And I worked with a generative AI software to try to develop these, and boy, did it not give me very much detail. Generative AI is not a bookkeeper. So you have assets up there for each of those stores. And you can see already there's some differences, right? The different stores have different amounts of cash on hand. They have different amounts of accounts receivable. They have different amounts of inventory on hand. So their total number of assets are quite different. Liabilities as well. Liabilities are what you owe. So current liabilities are liabilities that are owed in the next, in the next short term. You might also have long-term liabilities that are, let's say you have a 5-year loan. That's a long-term liability. A current liability is what's owed in the next. Maybe that's invoices that are due to vendors you work with, but due in the next period. And accounts payable, those are invoices that you owe somebody, right? So accounts payable is part of current liabilities. And then you have equity. So it's called a balance sheet because it should balance. If you get out your calculator and you do some math, assets, that total number up there of 360 and 225, should equal liabilities plus owner's equity. So if you add up, if I've done my math right, the 83,922 number plus owner's equity, you get the total number of assets. And this makes sense, right? If your business is, if your business owns a certain amount of things and has a certain amount of cash on hand, but you owe, a certain percentage of it, then the company's worth, owner's equity, that's what the company's worth. The company is worth those assets minus the debts that you have, right? That's where you get to that balance sheet equation. So just based on this information, and this is, again, not very much context. You don't know anything about the size of the different locations or what kind of store it is, but just based on this, if somebody were to hand you the keys to one of these locations and say, this is now yours, which location would you prefer to own? Give me a hands up if A and a thumbs up if B. Hands up for A, thumbs up for B. Thumbs up should also be under that reactions. I'm seeing a lot of A. All right. Let me see. Do I have the ability to react? I don't. Okay. Okay. Yeah, actually, let's put this in the chat. Say A or B in the chat. If you'd A, if you'd prefer to be given the keys to location A, B, if you'd prefer to be given the keys to location B. Okay, it's a nice mix so far. All right. Healthy amount of both A and B. Awesome. Okay. So let's give you a little bit more context. All right, so let's look at the income statement for quarter 4. So this is July through September 2024, this company, or quarter 3, July through September 2024. So this is a company that has a calendar year, fiscal year. Their fiscal year is January through December. So quarter 3 for them is July through September. Your business may have a different fiscal year. Maybe you align with the federal fiscal year because you're a federal contractor, and that federal fiscal year ends at the end of September. Maybe you have a very seasonal business and you've chosen to have your fiscal year end right at the end of your busy season. So you're paying your taxes while you're flush. In which case, you might have a different fiscal year end than the calendar year. In any case, this business has a calendar year, fiscal year. So quarter 3 for them is July to September. So notice the balance sheet is as of one specific day, September 30th. That's the end of quarter 3. The income statement shows a period of time. So it's July through September. And in that period of time, revenue, how much did the business make? And then there's deductions from the revenue. So there were returns, and there also is the cost of goods sold. So let's say the store sells clothing. Cost of goods sold would be the cost of inventory, right? If you sell a $100 dress, but you paid $20 for it, the revenue is $100 and your cost of goods is 20. So this is, again, there's You often see a lot more detail in these income statements. I've kept it pretty slim on the detail for the purposes of doing a useful analysis, but you'll often see a little bit more detail on these statements. And then gross profit, that number 348,052, that's not the take-home pay that the owner gets, right? That's just, the revenue minus the cost of earning that revenue before all of your overhead, your operating expenses. So operating expenses was a total of 204,000 for this business, and that's broken down into labor, general and administrative costs, sales and marketing. And G&A would include a wide variety of things, but potentially, things like rent, right? Um, and then that gives you your EBITDA, that's your earnings before income, taxes, depreciation, and amortization. I'm sorry, earnings before interest, taxes, depreciation, and amortization. Interest being the money that you're paying on the loans that you have. Taxes, of course, being your tax burdens. Depreciation being any depreciation and amortization are ways to spread the expense of a big purchase or the value of a big asset acquisition over a period of time, usually for tax purposes. And I encourage you, if you're curious about this, to ask an accountant or do some Googling. It's a deep rabbit hole, but it's interesting stuff. So there are no fixed assets, no depreciable assets in this business, as we saw on the balance sheet. So there's no depreciation or amortization. There's no long-term liabilities. Therefore, there's no interest expenses, but they do have a tax liability, and that's taken out here. That's 28,000. Gets you to your net income of 114,832. Okay. Those of you who said location A, you still feeling good about location A? I bet you'd prefer to see the context of location B, right? It's always easier to assess a business when you have a comparison or a comparable. So let's find a comp. So location A, location B. Okay, so different numbers of revenue, different numbers of returns. So it's from here, I'm going to ask you at this point, and I'm going to even do it. I'm going to do it as a poll. I love a poll. We haven't done a poll in a little bit. Let me get a poll here. Okay. A and B, and I'm launching this poll now. Okay, so again, we don't have the full picture, but let's from this information, which business would you rather own? Which location of this business would you rather own? And they're selling the same stuff, right? Which location would you rather own? A lot more of you picking B. One of you who picked B, come off mute and say why, because I agree with you, but I want to know why. Who wants to tell me why location B? You can raise your hand and I can unmute you. I'm not sure who just raised your hand. Fatima, would you wanna tell us why? Maybe not. Okay. Um, all right. So what I'm expecting is the why is that net income. That's why I want to draw your attention to at the bottom. One of them has a higher net income than the other, right? Top line revenue, not the same thing as net income. So location A is making more money in gross receipts, but it is not making more money in net income. The operator of this business of location A is taking home less than location B. And it's even easier to see this if you express everything as a percentage of revenue, which is why I love a spreadsheet for this because you can make it do the math for you. So notice also, so location A has 16% net income. 16% of its business is net income. 24% of location B's gross receipts are net income. So it's definitely doing better in terms of its overall profitability. Absolutely. It does have a slightly higher return rate. And this might be, notice also it has lower labor costs. Location B has a lower percentage of revenue spent on labor. and a lower percentage of revenue spent on marketing. So a couple of things could be happening here, right? Location A maybe is overspending on marketing. Maybe location A is also maybe overstaffed, or maybe location B is understaffed, and that's why they have that higher rate of returns. It's not enough to impact their profitability, though. Uh, it would be even more helpful, right? Maybe you'd have even more of an understanding of which business is doing well if you saw some other key metrics. Maybe if you saw, the sales per square foot for a retail business as a great metric to track, or maybe you would want to see um, the customer loyalty numbers, customer retention. How many of these sales are to repeat business? Um, I would expect with the amount location A is spending on sales and marketing that they're not seeing as much return business as location B is. And that's why they're spending more on marketing to get folks in the door. But if you had, let's say you found online, there was a resource that gave you an approximate, financial breakdown for expenses for a retail clothing business. Those percentages would give you even more information about who's doing better and worse than the benchmark in certain areas, who's overspending or underspending or underperforming or overperforming in certain areas. The final one we want to see is the cash flow statement. So the statement of cash flows is um, so I'm sorry, I just got a question. Getting problem to get a income part. If you can be more specific about your question around income, I'll do my best to answer it. But you'll also get a recording for this webinar afterwards, and feel free to look back through. So your cash flow statement again shows cash on hand, what's going in and out of the business. So this isn't very enlightening for this business because there's not much debt, there's not much real estate assets, there's not a lot. The cash that's changing hands more or less aligns with the operating with the income statement. But notice here that if that the cash on hand at the beginning of this period is less than 1 month's payroll. If you look at the profit and the income statement, you can see that they're spending, location B is spending probably what, $25,000 a month on payroll, and they have less than that on hand. I would never advise letting your cash on hand fall below 1 month's payroll. So that's location B. Those of you who said location B, I don't know, a little nervous for you. All right, I'm going to go ahead and we're going to, so you can see here with a cash flow statement, beginning cash on hand, this is what they earned, the net income. So cash flow from operations, that's that net income. So this number at the bottom of the income statement comes in right here at the top for net income. Cash on hand is coming from your balance sheet. Your balance sheet shows, cash on hand as of September 30th, and that, there's your cash on hand at the bottom of location A and location B. Cash flow from operations, that's that net income, and changes in accounts payable. They've, in parentheses is negative, by the way. That's the convention in financial statements that parentheticals refer to negative numbers. Cash flow from financing, there was a slight increase in current liabilities over the period. So your net cash flow is calculated there, and that gets you to your ending cash on hand. Your beginning cash on hand plus your net cash flow is your ending cash on hand. And that is the cash that we saw on the balance sheet for both businesses. You can see how these are all connected. It's difficult to look at one and come into a good conclusion without looking at the full picture of all three. And even then you might have very reasonable questions that would be difficult to answer without knowing a little more about the business. So your financial statements might guide you to ask certain questions of your operations, or if you're considering buying a business, they might prompt you to ask questions of the seller. If this person were trying to sell me one of these locations, I would say, hey, tell me about the personnel. How many staff do each of these locations have, right? Why is one labor cost, why is one paying so much more in labor than the other? I might ask, can I see, more than 1/4 of financial statements? I might ask for, 3 years so I can go back and compare trends over time. So I would have a very different take on location A versus location B looking at these if I knew that location B had been struggling for profitability last year, and has been operating really lean. They've cut a lot of their labor, and maybe they're cutting a lot of their they carry less inventory on hand as well, right? If you look at the balance sheets, they've got a lot less on inventory. Is that a problem from a sales perspective? Do they have the range of sizes for a clothing store? Are they keeping up with bringing in new seasons of clothing? So I might have some questions based on this, based on what I'm seeing in these financial statements, um, for the operator, right? And those are questions if you're looking at your own financial statements, you could be asking yourself or your team, about your business. But it's always helpful. Again, there's two different kinds of financial statement analysis. There's horizontal, so that's where I would say, okay, 100% of revenue, 16% net income. That's a vertical analysis. Horizontal analysis is looking at over a period of time. So we're not doing horizontal analysis today because I was not able to generate 3 years of financial statements for this hypothetical business. But you can do a horizontal analysis in your own business, and that's where that's the really powerful thing to do, is to look back not just at what happened this quarter, but what happened this quarter compared to last quarter, this quarter compared to Q3 last year, etc. So let me switch over and talk about building strong financial habits. Before I do, we've got, I walked through those financial statements pretty quickly. If you have questions about the financial statement components and you'd like to get a little bit more information, or maybe somebody to sit with you as you review your own financial statements, reach out to us. This is something we can certainly do for you. And I'll put my email in the chat if you'd like to get in touch, and we can find a time to sit down with you and take a look at your financials. There's also a ton of resources out there around how to read financial statements, and also how to do basic bookkeeping as a business owner. LinkedIn Learning has some really great classes if you have access to LinkedIn Learning. And if you live in Philadelphia and you have a library card, you have access to LinkedIn Learning for free through your library card. There's all kinds of, Khan Academy and other online learning platforms that have really great information about record keeping and financial analysis. So if this is really in an hour, we don't have enough time to get as deep as maybe it would be ideal to get into these topics. Don't let this be the end of your journey. Keep learning more. So practically speaking, we know, it's important to keep good records and it's important to track your financial performance. But what does this mean, right? As a business owner, I know all of you are struggling to fit everything you have to do into a 24-hour period, including sleep. Sleep is important. So how do you actually fit this into your operations? What is, in an ideal world, how often would you be doing certain financial management tasks? I have a snapshot for you. Every day or every week, you should be keeping track of those income and expenses, those transactions. A transaction is either an income, a sale that you made, or an expense, a purchase that you made. And you might see these also talked about as credits or debits. So you're in your business bookkeeping software, you have accounts. You have your bank account. And if money comes in, that's a credit. If money leaves, that's a debit. You've heard of your debit card, right? That's a debit. So you want to be tracking those transactions, those income and expenses. You want to be monitoring your cash flow, right? Do you have enough cash on hand to cover your next week's worth of expenses? And you want to be invoicing promptly. If you've performed a service, get that invoice out as quick as possible. And then follow up on those invoices, right? Set a calendar reminder to follow up. Overdue invoices, and you can really, it impacts your cash flow because it's money that you're not earning, that you're not able to therefore spend on other things. So that's weekly, ideally. Daily, if you use a bookkeeping platform that syncs automatically. And then that includes, if you're using bookkeeping software, logging in every week to categorize the transactions and check the categorization, right? A lot of these tools are going to automatically kind of categorize transactions. And then you can come in and just say, yes, that expense was for inventory. Yes, that expense was for equipment. Yes, that expense was, I paid a vendor, right? And you can set categories for specific projects that you're doing. You can build categories for each of the different product lines that you offer, each of the different services that you offer, and compare which services are generating more sales, which services are generating more dollar amounts in revenue, right? So you can think of sales as a specific single sale or as a dollar amount. You can see, okay, if you're a retail business, you might want to track the average transaction amount that your business sells. That's a really useful metric. And growing that metric will get you more income without needing to get you more customers, right? If each customer spends more, you're making more with the same number of customers. It's a great thing. And you won't know if you are or not unless you're keeping track of your revenue. So daily, that's one of your big tasks, is tracking those income and expenses. And everything else flows from that. If you don't have good numbers, you can't do a good analysis, you can't make good decisions. You got to get those numbers in. Monthly, you're reconciling your transactions with your bank statements. Anything on that bank statement you don't recognize, that's a problem. Again, some of these tools do this for you automatically. You want to have your bookkeeping platform generate some financial statements and do kind of a mini version of the exercise we just did. This month compared to last month, this month compared to 2 months ago, this project or service compared to this product or service, right? This location compared to that location, this salesperson compared to that salesperson. Helpful to compare. And depending on your business's goals and your key metrics, you might, look at pull different kinds of reports. Every month you're paying bills. You want to review your budget to, review budget to actual, meaning last month I budgeted this much in sales and I budgeted this much in expenses. How did I do? And every month you want to set money aside for taxes. Because I don't know if any of you have been in business long enough to have this surprise, but it's not a good surprise. Your first year in business, that April following close of your first year, oh, I have to pay somebody. I have to pay the IRS a big chunk of what I made. I hope none of you got that nasty surprise. When I started my first business as a 20-year-old, I did not understand business taxes, and I absolutely got a negative surprise. The April following my first year, I was like, oh, I owe that much in taxes. I don't have that much cash on hand, and I got on a payment plan, and it was a real pain in the butt, and I don't recommend it. So put some money aside for taxes. Every quarter, you're analyzing, you're estimating and paying your quarterly taxes. That could be sales tax. It could be, your quarterly business taxes if you're a quarterly filer. Every quarter, you're doing a bit of a deeper dive into those financial statements and analyzing your overall performance. Maybe you're setting performance goals. And again, depending on your business, you might have different kinds of performance goals. And get in the habit, if you have employees, of checking your payroll once a quarter and just making sure everyone is being paid what they should be being paid and benefits are going where they should be going and you're withholding what you should be withholding. Just double check it. Payroll companies make mistakes. Double check it. And then once a year, you're preparing your year-end financials, you're filing your annual business taxes, you're reviewing your overall performance year over year and any trends, and planning for the next year. And at least once a year, you should talk to your accountant to make sure that there aren't any tax credits you should be aware of that might change how you operate, any changes to your operations that maybe it's beneficial for you to switch over from being a disregarded entity to being an S Corp or a C Corp. Talk to your accountant. If you don't have an accountant, find an accountant. It's a really, really, really critical business advisor to have in place. Have an accountant. And if you have a good accountant, keep them. Not that easy to find. If your business does not make any money in its last fiscal year, do you file business income taxes anyway? Says the question asker. This is a great question, and I was about to say, anybody have questions? Yes, if you have an entity that exists, if you filed, you got an EIN and you've got a business license, then the tax authorities are expecting to see a business return for you, even if you did not make any money. So you'd want to record, you can either file if you didn't have any operations at all, no expenses and no income, file it with zeros. It's pretty easy to do. If you had only expenses and no income, same thing, file it. And maybe if you're a disregarded entity filing as a Schedule C in your personal tax return, maybe that has maybe there's some slight tax benefit in reducing your overall tax burden. But yeah, absolutely. You file business taxes as soon as you have an entity that has a tax ID. Yeah, great question. We are coming up against time. We got about 5 minutes left. Hit me with your questions. We're going to drop a survey in the chat. We want to know how we did. Please let us know how we did. Um, this is our first time running Financials 101. So if there's topics you wanted us to cover that we didn't, if you really liked how we covered something, we want all that feedback. It really does change how we operate. I'm happy to take more questions, and I'm going to leave this up in case you want this. Question in the chat. Is it true that if you don't report income for a few years, your business will then be considered a hobby? I don't believe that's true. I mean, it's certainly true that if you don't report income for a few years, if I'm a lender and I'm looking at a loan application and you've had a business entity that has had no income for a few years, I'm not considering you to have been in business for that long. I'm considering you as a startup. So from that perspective, it's true. I don't know because I'm not actually a CPA. I should have said that. I'm not an accountant. I'm just an enthusiastic business consultant. I don't know if the IRS changes how they designate your operations based on how long, how much income or not you've had. I would expect there's some kind of classification. I don't know what the exact threshold there is. Um, but it's definitely true that if you're coming to me as an investor or as a lender and you're saying, well, I've had my LLC for 10 years, I'd say, okay, well then how many years, what income did you have last year? How many years of business taxes do you have? And you tell me, oh, I haven't actually had any income yet. Well, I don't think of you then as a 10-year-old business. I think of you as a pre-venture business, somebody who hasn't yet been operational. And that's, again, there's nothing wrong with that. All of us start there. But it would probably impact how I view, the credit worthiness that I attribute to your business entity. Yeah, great question. We have time for one or two more. And there's a link in the chat. Please use that to fill out the feedback form while you're writing up your questions. Mm, yeah, I needed this. Man, when I was 20, which was more than 5 years ago, I won't say how many more, but a few years ago, I really needed this information. I learned a lot of this the hard way. Hopefully, you all don't have to learn it the hard way. But yeah, absolutely. Thanks, Philippa. Anybody else have a question? Would I recommend applying for a business startup loan if you haven't made any revenue with a business entity that has been established since 2021? It depends a lot on the amount of the loan and your personal credit. Can you check that link for the survey? By the way, it's not working. I can pull a survey link. But yeah, I mean, it depends a lot on the specifics of the business. So if you were, let's say you're applying for a micro loan, a loan of 10,000 or so, and you have home equity you have 40,000 in home equity. Even if you're a startup, let's say your personal credit score is 700, go for it. You'll probably get that loan. However, you won't get it from one of the major lenders. You'd probably need to work with a micro lender, a CDFI, they're called. So it's very case by case, and please feel free to email me your questions or reach out to me more individually, and I'll be very happy. I think, does this, yep, it's not working. Okay. Yeah, we're gonna send that form to you in the follow-up email, and please do complete it then. Okay, a couple of questions here. Loan versus business credit. Depends on how you're able to, it depends on the credit worthiness of your business. A business that's less than 2 years old is typically not able to access very much in the way of revolving credit, but you can usually get a loan. And how you use them depends on how long you're going to need that money, right? If all you need is money for a short amount of time that you'll be then able to pay back very quickly, let's say within a month or two, line of credit card, that's the right answer. Whereas if you're going to be buying a building or a piece of equipment that might not actually pay for itself until it's for a year, 2 years more, that's a loan. If that helps, Philippa. And if there's more there, please feel free to follow up with me. Grants for startups. There are not that many grants for startups. They exist, but there aren't a ton of them, and they're typically very competitive. We advise people when they're planning a startup business to think more about personal savings, friends and family borrowing, micro lenders, crowdfunding rather than grants. They're usually not going to cover all or even very many of your startup expenses. Um, any recommendations on where to go for basic tax help if you don't have an accountant? Well, Brenda, we are running a tax clinic this summer. And please check out our social media and our website to find out more information about how to get access to that tax clinic, because we can help you get up to date on those taxes if you're talking about business taxes. Um, for personal taxes, if you're behind on personal taxes, I know that there are some organizations around the city that run tax clinics for income taxes at different times. But reach out. We might be able to direct you somewhere to help. Um, that's all we have time for today, but thank you everybody for coming. I hope this was useful. And um, um, okay, I will. So you can find our social media if you go to temple.edu/SBDC. That's where you'll find all the information about us and what we do. Follow-up Zooms that could offer more information in regards to questions that were asked. We do have, other webinars planned. If you have specific ideas for classes and topics that you'd want to hear us talk about, um, reach out, let us know in that survey what you're looking for. We do offer a financials focused webinar, once a quarter or so. And we also, of course, work one-on-one with people. We offer no-cost business consulting that includes things like financial analysis of your business. Um, which brings me to, I think somebody messaged me, how do I find a business mentor? SCORE offers mentorship. SBDCs offer consulting support. So if you're looking for a consultant, go to temple.edu/SBDC and click request consulting and go from there. All right, I'm going to run. Thank you all for joining, and I hope you have a wonderful rest of your day. Have a good one.